Já, takk Yngvi. Mjög áhugavert efni. Ég ætla að benda ykkur á að þetta verður allt aðgengilegt á vefnum okkar hérna eftir fundin. Næst ætlum við að fá innsýn í það hvað það er sem býður okkar handan hafta, hver er staðan og hvaða horfur eru á helstu heimsmörkuðum. Við höfum fengið Matt King, sem er Head of Credit Product Strategy hjá Citigroup til okkar. Next, I would like to welcome Matt King to the stage. His team at Citigroup is responsible for forming views and advising clients on a full spectrum of credit across high-grade, high-yield, leveraged loans and structured bond markets. The majority of clients are investors, but Matt also deals with issuers and regulators on everything from market direction to valuation to risk management. Matt is a frequent speaker at industry conferences and has published extensively on credit markets over the past 2 decades. Some of his most widely referenced pieces are The Broker's Broken, which was published 2 weeks before the Lehman meltdown, and Buy the Bubbles, Sell the Bath, and How Much Debt is Too Much Debt. Erindi sitt hér í dag kallar hann Don't Look Down, You Might Find Too Many Negatives. Nú, þegar Matt hefur lokið sínu erindi, þá mun Steinþór Pálsson loka þessum fundi og við áætlum að klára fyrir 10:30. Takk.
After the long, dark winter, finally comes the light, and with it, we hope the return of summer. And at this point, I guess we might hope that not only in meteorological terms, but in economic and investment terms as well. And yet this is Iceland. You guys do things to extremes. You put your freezing cold glaciers right next to your red hot lava flows. You have a tiny population and yet an outsized global impact. You have a bigger credit bubble than anyone else, but you also do a much better job, a much more comprehensive job of cleaning it up. And I think it's that realization which is critical when it comes to making sense of what markets globally have done so far this year and are likely to do in future. Because the rest of the world isn't as extreme as that. The bubbles haven't been as big, but nor have they been dealt with. The start of this year featured basically the biggest sell-off in risky assets at the beginning of any year on record. And I think it's critical to ask the question why that was. For almost all economists and central banks, it's a bit of a mystery. They're left looking for some sort of external shock to make sense of it. But there really wasn't one. What I want to do today is paint a completely different picture, but one which I think is much more persuasive. It's one where central banks have been so desperate to create growth and inflation globally that inadvertently they have been creating credit bubbles. It's one where markets across the board are being driven not by underlying fundamentals, but by investors buying things because of central bank liquidity and planning on being in today, but getting out tomorrow the moment that environment changes. And it's one where, therefore, I do end up bullish both on my market's credit, but also on global equities, but for all the wrong reasons. It's all about that central bank liquidity, not really about valuations. And it's a world which I think is much riskier than the central banks themselves would have you believe. And for me, the central challenge in investing at the moment revolves around how I put that risk, how I factor that uncertainty in the global outlook into portfolios. To persuade you that this is the right way to think of things, I've divided my presentation into 3. To begin with, we'll look at what's been ailing markets. Then we'll look at the likelihood that the rally that we've been having recently continues and builds upon itself, where, yes, there's been some help from the European Central Bank in particular, but more or less the sell-off fizzled out by itself and then reversed. And then lastly, I'll look at the risk that at some point we return to what we were doing early this year, where a nasty sell-off in markets across the board threatens to build upon itself and take the economy with it. But I guess if there's one thing that I want to convince you of in the next 30 minutes or so, it's of this distortion in the markets. It's the fact that it's central banks and credit that are driving everything. And while on the one hand, as you guys know, that's a very powerful force on the way up, as you also know, it's much more fragile than anyone really wants to face up to. To begin with, then, it was a horrible start to the year. And it's funny because it's almost completely disappeared now, and yet I think it sort of builds upon something that's been happening over several years. Even last year, in global market terms, 0 was a good return on your money. We like to joke that when everyone gets really nervous and the bubbles burst, investors will realize that sometimes 0 is a good return on your money. Well, last year it actually was. And I guess what's striking is it wasn't just long-only investors who struggled, it was also hedge funds, it was also investors with full ability to go short as well as long, and still it was really difficult. This year, in some respects, has been more straightforward in that first there was a big risk-off move, and then there's been a big risk-on move. And yet here too, even though in principle these have been fantastic opportunities for investors to take trading positions, in practice most have found it very, very difficult. And even more striking still, I think, is the lack of an obvious explanation for what markets have done. The most likely thing that everyone would point to is oil. And indeed, a lot of the time, there have been positive correlations between credit, between equities, and oil prices. But it's not all of the time. There have been periods where oil was recovering, and yet markets were selling off regardless. And it's sort of the same if you look at another potential explanation, China. Often the central banks, Janet Yellen referred to it just earlier this week, the risks from overseas, and mostly people mean an emerging market slowdown, but we managed to have the most intense week of sell-off during the period where China was shut for Chinese New Year. And likewise, at one point everyone was saying, oh, it was the European banks, oh, maybe it's a problem with the banking system. And yet you look at the broader situation, it wasn't just the Eurozone banks, it was Swiss banks, it was Japanese banks, Swedish banks did rather better. And so maybe you start to think, was it a problem with negative rates? And to my mind, what really went wrong was a sort of drying up of investor risk appetite. What's been driving markets the last few years is investment inflows, investors reaching for yield, going out and taking risk in both credit and equities. And what happened in about April last year in the US is those investment inflows dried up. People started putting money on deposit rather than buying risky assets. And what happened in Europe early this year was the same thing. Now, the last few weeks, that has tended to reverse, but it's these investment flows, that risk appetite, if you like, which to our minds is critical. And I guess what's further striking about all of this is this occurred in an environment where the central banks did not withdraw their liquidity. Lots of people like me think that central bank liquidity has been an important driver of market flows the last few years and have been worried that when we hike rates aggressively, when we withdraw the QE, there will be a problem. And yet what seemed to almost precipitate the sell-off was the BOJ cutting rates, was Sweden cutting rates more deeply into negative territory. And yes, it's corrected with more stimulus from the ECB, but again, it's not that there was this sort of obvious big shock which suddenly precipitated that sell-off. And to our minds, what is going on is a bit more sinister, but also a bit more long-term and slow-moving. And that is that the ability of central banks to make investors reach for yield seems gradually to be fading. And this has been going on for some time. So if we think what quantitative easing, what QE is supposed to do, or rate cuts for that matter are supposed to do, one of the most obvious things is to push up inflation and inflation expectations. And we can plot the effectiveness through time. In the US, during their first lot of QE, that's exactly what happened. Inflation expectations rose steadily the whole way through. They did so at the beginning of QE2, but then they fell back again. They did so at the beginning of the Fed's Operation Twist, but then they fell back. And inflation expectations in the US fell all the way through the third lot of quantitative easing. And while the ECB has been doing its quantitative easing, again, global inflation expectations and Eurozone inflation expectations have been falling. That's really disturbing. That's not supposed to be happening at all. One way or another, the central bank effect feels as though it's been wearing off. And you can point to the same picture if you look at relationships with credit spreads or with global equities. We rallied in QE1, we rallied a bit less in QE2 and QE3, and then we've been selling off all the way through the ECB's QE, right up until the latest announcements from Draghi a month or so ago, since when, yes, we have been rallying, but again, there are big question marks as to just how long-term an effect this will be. To my mind, the only way you make sense of what markets have done this year, and indeed last year, is if you think not in terms of some external shock from oil, not in terms of some external shock from China, and if only China would leave us alone, everything would be fine. If you instead think in terms of a crisis of confidence in central banks as their ability to inflate markets and push up inflation expectations through expansion of credit, seems to be fading, in part because there's so much debt that's been built up already. Let me turn now to the likelihood that this ceases to be a problem, that it fizzles out by itself. And there are some signs of this already, because what's happened the last few weeks is, yes, aided by the ECB, markets have been rallying back again. Valuations had become really quite extreme and are still quite generous. Credit spreads, for example, and also people would argue equities, although a bit less now, got to the point where they were pricing in a recession even when the economic data wasn't really suggesting that we were yet in a recession. And likewise, even though those spreads were high, it's not like the debt was unaffordable. Interest rates generally, or yields on corporate debt, are so low that very few companies actually have problems meeting their interest payments here. And likewise, if you think in terms of those cheap valuations, there always was a likelihood that just as we saw last year, where there was a nasty sell-off in August and September, but then many of the bonds bounced back very aggressively, that this would bounce back kind of by itself. Markets do overshoot. What drives markets is not just the fundamentals, it's the change in the consensus. It's the change in what everyone else is thinking, and sometimes they get overly bearish, and then you're vulnerable to bouncing back again. And likewise, you can point to continuing strength in global labor markets and falls in unemployment, and you can point to some other bits of economic data, such as an improvement in credit growth in the Eurozone in particular, suggesting that if normal economic models apply, then that momentum should build upon itself. There really shouldn't be a problem. I think more important still has been the fact that investors really did get very bearish. When I look at my client survey, which asks investors whether they're long or short, in my case in credit, what we saw is going into the ECB a month or so ago, investors' positions were as short as they had been even at the depths of the crisis in 2009. When everyone gets that bearish, you are vulnerable to or prone to these sorts of rallies back again, just when things turn out to be not quite as bad as everybody was imagining. And in principle, that sort of squeeze on everyone's short positions can in turn begin to generate positive inflows to risky assets, and then as returns improve and investors come back to markets, so you can build on this and get seemingly a more normal sort of recovery. And yet I don't think it was just that investors got bearish for no reason. To our minds, there are disturbing signs of weakness in the global economy. And you don't quite know the extent to which they will build on them, especially if we can prop markets up. But there were signs of a global slowdown occurring in any case. There's been weakness not only in the manufacturing sector, but also in global services sectors. And likewise, again, in a world where, frankly, it's the Eurozone and Japan where the global growth indicators look good, Europe and Japan are not famous as engines of global growth. If the US and emerging markets are as weak as many of the indicators suggest, there is a problem. And this is why, for example, again, Yellen came out being very dovish and cautious in her speech earlier this week. And yet, to our minds, it's sort of more disturbing than that. Because one way or another, there are signs that this cycle is not playing out the way that central bank models say it should be. Why was it that the Fed did hike rates at the end of last year? Basically, it's because their models say that inflation should be around the corner. And there are starting to be some signs of a pickup in core inflation. Unfortunately, what the Fed has been very quiet about is the fact that their models have been predicting a pickup in inflation and in growth pretty much continuously for all of the last few years. And basically, we've just not seen it. And likewise, one way or another, it's not just the Fed models, it's also our economists' models, again, have been consistently over-optimistic. Somehow an engine of growth, which has been there in all the history they build the models on, has been missing. And I think a lot of that has to do with credit. Credit, desire to borrow, desire to take that borrowing and go out and invest in the real economy, has been really very lackluster, even as the rate at which companies can borrow has got lower and lower and lower. And it's that situation which leaves things awkwardly poised now. Maybe, yes, this rally continues and builds upon itself, but given how stretched everything has become, I fear that there is much more vulnerability than you would have thought, say, from prices or volatility levels themselves. And it's that I'm going to turn to lastly. To our minds, what we're likely to be doing now is going back to the same environment we were in 2011 to 2014. And that, for me, is an environment where markets are generally going upwards, but it's all because of central bank liquidity. It's not because of fundamentals. And that distortion by itself implies a vulnerability. And I think it's important to think that the weird thing in markets was not the sell-off early this year out of the blue. The weird thing in markets is where we've been the last few years. As a strategist, we spend a lot of time looking for what is driving global markets. And we rely on relationships that seem to work for years or decades. And what's disturbing over the last few years is the way in which many of them broke down. So, for example, I've illustrated it here with Europe equities, but actually this works in every region we look at. One of my favorite metrics is earnings revisions, or the change in consensus expectations for earnings. Are analysts getting more bullish, in which case markets tend to rally, or are analysts getting more bearish, in which case markets tend to sell off? And you can find these earnings revisions indices, the Citigroup earnings revisions indices on Bloomberg. Those relationships work in every market we look at, right up until about 2011, 2012. Since then, earnings revisions have been negative almost every week in almost every region. Analysts have been revising down their earnings expectations. And yet, most of the last few years, equity markets have been rallying because it's not been about the underlying fundamentals. It's been about too much money chasing too few assets driven by central bank liquidity. And we find similar breakdowns in other markets. In my market, credit, spreads used to follow corporate leverage. Lots of debt, spreads are wide, everything is risky. Not much debt, spreads are tight. But since 2011, companies have been leveraging up, and spreads have mostly been tightening in anyway, until the last year or so. And I think a better explanation of what's been going on all this period, as I say, is basically central banks driving investors to buy things regardless of the fundamentals. And the sad thing is, though, is that in 2009, 2010, 2011, that worked really well. The right trade was out of cash and into everything else. And one asset at a time, whether it was commodities, whether it was gold, whether it was emerging markets, it looked like a fantastic investment as more money came in afterwards. And yet equally, one asset class at a time, what you hoped was a good investment to begin with, has suddenly turned out to be really rather awful. And central banks have been fighting to prop everything up. It looks as though, again, they may succeed, but already what showed up last year and has shown up in the early part of this year is the vulnerability that comes when markets are distorted like that. And what's disturbing is that whenever we've got into difficulty, which here I've illustrated with credit spreads, whenever spreads get wide, whenever equities have sold off and the world is looking like a risky place, it's always been the central banks who've rescued us. Draghi doing whatever it took in 2011, aggressive easing from the Fed and QE in 2008 to 9, Likewise, aggressive central bank easing, normally more than 2% of easing in policy rates. But when you start from zero, and when you've already been doing QE for all these years, it gets much harder to achieve some of that. And that's one reason the Fed is staying dovish, because they're hoping they don't need to take rates negative. They're hoping they don't have to go back to QE, because they're not sure how they do prop up the economy if the sell-off builds upon itself and you go back into recession as a result. And again, for now, through the ECB buying corporate bonds, I think and for the Fed being dovish, these problems seem to be postponed. But again, you can paint a very real argument that ECB QE in particular has done none of the things that it was supposed to. It was supposed to push up inflation expectations, and they've fallen. It was supposed to push down real yields once you subtract out inflation, and instead they've risen. It was supposed to compress credit spreads, and instead those have risen. It was supposed to push down the euro, and the euro's moved up. It was supposed to push up the equity market, and it's moved down. And this, again, is deeply concerning, because if central banks' instant reaction to problems is a little bit more of the same, and yet investors aren't responding in the way in which they used to, we have a problem. And what I think is further striking is that the problem seems to be a global one rather than a regional one. This drop-off in inflation expectations has occurred everywhere. These disinflationary pressures that seem to be present in the global economy, some people would argue through secular stagnation, others through globalization and China. I guess I would attribute it to overcapacity that was built up during the credit bubbles of the last few decades. This is a global problem. And as such, while it does link to things like commodity prices, it means that one way or another, individual central banks are not as fully in demand as they might like. I mentioned before how many of our fundamental relationships for understanding market moves seem to have broken down. The relationships that have replaced them are all ones featuring central bank liquidity, featuring central bank balance sheets. These days, the joke is I don't analyze corporates at all, I just analyze central banks, and that tells me where equities are going. That tells me where credit spreads are going, either in Europe or globally. And the relationship that we found that seems to work is one where, quite literally, we take the size of, or the change in the size, of global central bank balance sheets. We look at how many securities they are purchasing. And over time, we've shifted this from one market to another. And in particular, it looks to us as though it's not just about developed market central banks, it's also the expansion in emerging market FX reserves previously, and their contraction now, which when we take that black line and then correlate it with market movements, gives us these correlations. If this relationship is the right one, though, that is driving global markets, if it is all about global central bank liquidity, that raises a number of very awkward questions, because it means that the individual central banks are not as fully in control of their destinies as they would like to be. In particular, it means that money continuing to come out of emerging markets may offset everything that the ECB and the Bank of Japan are doing. And likewise, the fact that this one factor correlates so well with market movements, I find extremely disturbing. And I think is the explanation for why many investors are complaining about illiquidity in global markets or sudden market movements. Because to get a liquid market, what you want is a diversity of investors, some buying, some selling, some looking at technical analysis, some looking at fundamentals, some mark-to-market, some long-term buy and hold. But when one factor like this, with nothing whatsoever to do with fundamentals, correlates this well, if you were a long-term buy and hold value-oriented investor the last few years, you went out of business because it was central bank liquidity driving everything, and the markets were expensive, but they got more expensive still. And that raises very awkward questions about the potential for nasty down moves as well. Now, as it stands, for now, it looks as though the central banks are prepared to be more aggressive. And the ECB is doing credit easing and buying corporate bonds. And by implication, if we were to go back to a more aggressive sell-off, the suggestion is they might even buy equities. And maybe we'll even get that from the Bank of Japan sooner. I mean, well, they're buying some equities already, but maybe they could scale up the purchases. And in principle, especially locally, that does help. It's very difficult to want to short the credit market when the ECB is coming in and buying those bonds. But at the same time, as they're resorting to more and more extreme policies and distorting markets more and more with very little obvious benefit to the economy, again, I think it builds up those bubble risks, those bubbles that you guys have gone much closer towards dealing with than the rest of the world has. So lastly, where does that leave us from an investment perspective? Most of how we have tried to invest the last few years and are continuing to try now is as though this is a bubble. And if you're investing in a bubble-like environment, what do you want to do? Technically, we call it trying to get long convexity. To put it more obviously, what we're trying to do is get long both tails. We want to make money even if the bubble inflates much further than everyone imagines, but we also want to not get completely destroyed if actually the sell-off, we return to a nasty sell-off, and the central banks are not fully in control, and you end up with a new crisis much sooner than people are imagining. Now, how do I do that? There are a number of different ways, but the most intuitive is what we might call a barbell strategy. Don't reach for yield across the board and buy lots and lots and lots of risky assets. Instead, put most of your money in your favorite safe asset, if you like, which is probably something local given how high interest rates are, but then take a small amount and buy something really risky. Maybe it is global equities. Maybe it's CLO equity tranches. Maybe it's emerging market equities would be one of ours at the moment. Not because I particularly like emerging markets at this point, but because the valuations are so extreme that a continued recovery in the world economy actually has most scope to be reflected in a rally there. Within credit, we've tended to do things like sell some of the mid-ranking credits and then buy some of the most distressed ones with the lowest prices. Because again, that sort of barbell exposure, again, in developed markets, it might be a mixture of 30-year US treasuries with some of those extremely risky bonds within high yield. That sort of barbell exposure gets you long both of those tails, which, again, leaves you better protected than if you've reached for yield across the board, and then suddenly we find the bubbles are bursting rather than inflating further. To sum up then, what have we seen? It's really hard to make sense of the early part of this year if you're just thinking in terms of a shock. If you're thinking instead of a crisis of confidence linked to central banks, which looked very dangerous, now seems to have receded, but all hinges on confidence, then I think you have a much clearer picture. And it's a more vulnerable picture, just as bubbles are always vulnerable. For now, it does feel as though investors were overly bearish. Risk appetite is returning by itself, aided, yes, by central banks being more aggressive. But as valuations become more extreme, I do think it's worth remembering that, to our minds, this is all being driven by that pattern of global liquidity. And the central banks are not fully as fully in control either of the economy or, for that matter, of markets as they would like to be. And so while on the one hand that does leave me bullish and needing to be long, nevertheless I think it's a much more fragile environment than anyone else would like to admit. And that in turn comes from the fact that we have been much less good at dealing with our credit bubbles than frankly you guys have. Thanks very much.